Hello everyone, welcome back to All Financial Discussion channel. For this video, it's actually a continued discussion based on my previous video. Okay, so on my previous video, in fact, I have used this price to book analyze ratio to determine whether DBS is still a good buy or not. But in Singapore, we mainly has these three banks, DBS, OCBC, and UOB. This video, I will use this price to book ratio analyze to analyze these three banks, and basically from the outcome, I will decide whether DBS is still a good buy or not. So basically, bank is known for their dividends and also the growth. So from this exercise, you are able to determine whether DBS or maybe OCBC and UOB will be still a good buy or not. So this will be the objective of this video. Before I continue, guys, I'd like to urge you guys to help me by like this video. Guys, just a few seconds, help me press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer, this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you're willing to lose. With this, we are ready to kickstart today's discussion. I have extensively discussed these slides based on my previous video. I have said this. Actually, price to book ratio should be slightly more than 1, should be a favorable position. Okay, so but I have received email asking me to further explain why. Okay, so therefore I take this video opportunity to discuss why price to book ratio should be slightly more than 1. In fact, to be more precise, basically should be less than 3. Then I will say that this price to book ratio is a favorable position. Some of you guys actually send it to me. This price to book ratio is less than 1 is also a favorable position. But like I mentioned earlier on, maybe I will use this video, a live example in order for you to understand this concept, price to book ratio. Let's come to the example. So for example, I have this iPhone 17, which is priced at $1,000. Over here, you can see that there are 3 possible scenarios. Price to book ratio more than 1, which means that I actually bought this iPhone with $1,200. So from here, it's very clear that this doesn't make any sense because I actually pay more for the iPhone. So from here, I conclude that this is actually not ideal. The second case is much more so-called clear-cut, because I paid exactly $1,000 to an asset that is also $1,000. On another scenario, which is the price to book ratio less than 1, this actually means that I actually bought the iPhone 17 for $800. So from here, you can see that this is actually very desired. But keep this in mind. So phone is much more easier to decide what will be the price. But let's say this phone is actually changed to share, then it may have different philosophy. Investment, in fact, is forward-looking. What does this mean? This means that stock and also maybe bonds market, they in fact act as forward-looking machine. So asset price actually reflect what does the investor think of the future earning, economics conditions, and growth, rather than based on your past or current performance alone. Markets often price in anticipate developments early, frequently hitting bottoms before economics data improve, making proactive long-term and thematics analysis that is actually critical for success. This simply means that your stock basically will be forward-looking. Investors actually predict what will happen on the next few days, what will happen in the next few months, or even some case, what will happen in the next few years. So this is the meaning, forward-looking. Let's come back to the example that I actually illustrate earlier on. So from here, like I mentioned earlier on, so this is actually undesired. For example, if let's say this asset typically has a fixed price, then I'm very clear that this price to book ratio, which is more than 1, is actually undesired. However, imagine this asset is actually unpredictable. For example, this asset is actually a share that will be up and down. Okay, so under this scenario, which means that investor actually pay $1,200 for an asset that is actually cost $1,000. This simply means that investor has the confidence with this company because they are willing to pay $200 more to invest into this company. So therefore, for me, I actually said this price to book ratio, typically, I prefer it to be slightly more than 1, but less than 3, which is this favorable position. Definitely, I'm not saying that this price to book ratio less than 1 is undesired. From here, you can see that I actually has the margin of safety because the margin is actually $200. Instead of $1,000, I actually pay this $800 to own a share that typically costs $1,000. However, like I mentioned earlier on, share is actually forward-looking. This simply also means that investors don't have the confidence with this company, and therefore they are only willingly to invest $800 to buy a $1,000 so-called asset. This is why I say that most of the time I will give this a miss when the price to book ratio is less than 1. Therefore, like I mentioned on my previous video, that's why I actually prefer share that have this price to book ratio more than 1, slightly more than 1, but less than 3. Then I think that investor actually has the confidence on this company, and therefore investor actually invest more than the amount of the asset. In general, investor is actively looking for a low price to book ratio. Why? Okay, so typically they want to look something close to 1, slightly less than 1, or below the industry average, as this typically suggests that this stock is actually undervalued. Like I mentioned earlier on, this actually provide a margin of safety. A high price to book ratio, okay, so let's say it's more than 1 or more than 3, they usually indicate overvaluation. Okay, let's say for me, more than 3, I would say that it's actually overvaluation, or maybe high growth expectation. Okay, slightly more than 1, I would say that we are going to anticipate high growth expectation. Okay, but may be appropriate for company with high quality intangible like tech firms. Okay, so for example, when they are actually more than 1, this is quite appropriate for companies, for example, very high quality intangible like tech firm. Key consideration for price to book ratio. So this is what I mentioned early on. Investor actively looking for low price to book ratio, typically close to 1, less than 1. So they are potentially undervalued. Okay, but this can also indicate poor performance as the investor don't have the confidence on this company. Therefore, we have actually these value traps. Wow, high price to book ratio more than 3. This often indicate overvaluation. However, okay, so in some case, this is still likely, but okay, the market actually expected very significant future growth, which may be overwhelming. So therefore, for me, anything so-called the price to book ratio more than 3, I would not consider this as a good buy. Coming to the industry context, okay, so a good price to book ratio actually depend on which sector. For example, banks often have lower price to book ratio as compared to technologies company. Okay, so technology company in fact will have a higher price to book ratio. Coming to the limitation, okay, so this price to book ratio, they are in fact less useful for service-based firm. Okay, they basically have very few tangible assets. Coming to the application, while a low price to book ratio is generally preferred for identified potential undervalued stock, it should not be used in isolation, which means that I'm not supposed to use just this price to book ratio to determine whether this stock is still a good buy or not. Typically, it is more effective when we actually combine with other metrics such as the return on equity and industry comparison to mitigate the risk. Okay, so later on, I will use this tree bank to describe how we can actually predict the price to book ratio. Okay, so here is a side-by-side comparison of Singapore three banks, DBS, OCBC, and UOB. Okay, so what I'm going to do is I will use this price to book ratio to decide which one is still considered a good buy. And maybe from here, you are able to conclude that which bank is actually your preferred choice when you actually come to the buying of the stock. Okay, so with added context, okay, so this analyze will give you assess their relative valuations and determine, okay, whether DBS is still appear attractive as compared to its peer. Guys, before I continue, this is very important for me. I urge you guys to help me by like this video. Guys, just give me a few seconds. Help me press the like button now. When more you guys actually help me to press this like button, this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. For those who are new to this channel, and if you have learned something from this video, urge you to support me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for strong support. If you look at this link over here, you should be able to find the price to book ratio for the three banks, DBS, UOB, and OCBC. Let me do a summarize based on what this figure actually says. DBS with the price to book ratio around 2 point something, as you can see from here. This means that the market values DBS at more than twice its net book value. This simply means that investor actually expected stronger earning growth or superior profitability. Okay, so this simply means that investor has confidence on DBS, so they are willing to pay more to invest into DBS Bank. While OCBC and UOB, they in fact trade closer to 1.2 book value, as you can see from here. This actually suggests that they are actually valued more cheaply relative to their net assets, which means that they actually price closer to their net assets, which means that your so-called certainty about the value is actually over there. So with this, I cannot say that UOB or OCBC is not a good buy, but based on your different so-called study, you can actually anticipate which is actually a better buy. Let's zoom in to have more information. Okay, so basically I want to have a more detailed study on price to book ratio. So from here you can see that DBS typically has the highest price to book ratio, which means that investors actually pay a premium, okay, because they have strong belief in this DBS bank. While for OCBC and UOB, okay, for UOB you can see that they have the lowest price to book ratio. This means that they have the least premium risk relative to the book value, as OCBC is actually in between DBS and UOB. How can we actually interpret the difference between the three banks? For example, I have illustrated that DBS basically has a premium valuation. Okay, so this means that DBS has the highest price to book ratio. This means that investors in fact pay more for each dollar of net asset. Okay, so this is not necessarily a bad idea if DBS truly earns higher returns on equity and deliver consistent earning and dividends. So in fact, DBS has shown higher ROE as compared to its peer at times. So therefore, this actually helps to justify the premium that you actually pay for. A premium valuation can persist if investors expect earning power and growth prospect to remain superior. So next, how about OCBC and UOB, since they have around the same price to book ratio, which is cheaper as compared to DBS. OCBC and UOB with a lower price to book ratio, around 1.2 something. Okay, so this might suggest that they are relative undervalued as compared to DBS, or simply that the market actually has lower expectation for growth, profitability, or the risk profile. However, with lower price to book ratio, this can be look like a better value if fundamentals are similar, but it may also reflect higher perceived risk or slower growth. Why a higher price to book ratio might be still okay for DBS? This is because DBS has historically delivered higher profitability and dividends as compared to its peer, which can justify a higher price to book ratio. If you believe that DBS will continue to grow their book value and profit, paying a premium today might make sense. Why you actually will prefer OCBC or UOB? Okay, so because with lower price to book ratio, this means that cheaper in terms of the book value basis. This potentially will have more upside if the bank's performance actually improve. But cheaper does not automatically means better. You want to confirm the bank's earning prospect and also the risk profile too. With this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.